Now I'd like to welcome a veteran and certainly an esteemed member of our faculty, Pat O'Keefe, who is going to lead a deeper dive into an outlook for 2016. I think we're going to go do a little bit more exploration in not only in energy, but also in some of the other sectors. And Pat is joined by Carl DeCuna and Michael Pokrasa, and a woman who, if you don't know already, has become, I think, the most prolific bankruptcy and restructuring reporter in the history of the news media covering. Jody, welcome.
Thanks, David. So our session is the 2016 Restructuring Outlook, and I suppose for business owners and businesses, there's a reason why it's pouring rain here in West Palm as we talk about this. But I'd like to introduce the panel, but I would first like to give a shout out to the M&A Advisor. This is the 10th annual M&A Turnaround Awards, so it's a great milestone of a decade of recognizing this industry, and the 16th year that the M&A has been in business. So great shout out to the team here at the M&A Advisor. On my far left is Mike Pokrasa, Managing Director of Raymond James. To his immediate right is Jody Sue Klein, Senior Writer from Bloomberg. And to my immediate left here is Carl DeCuna, the Managing Director of Madison Street Capital. And Mike, maybe you give us a little deeper background to that introduction as to your perspective, from where you sit.
Sure, appreciate the intro. Mike Pokrasa, Managing Director at Raymond James, focus on primarily restructuring, also do some debt private placements. I think, just as a general intro for my views on the world for this year, I think, I think the market is certainly off to a weak start, as we've all talked about, for various global issues. But I think when you delve into the financial market side of things and sort of what's driving distress, I think really what we're going to see is, a lack of public market opportunities. So, already in the start of the year, there's been anemic equity underwritings, debt, in terms of bond and loan underwritings, and even in the convert side of things, not much going on. And, in my view, at least, that's going to drive people towards, where to put capital. And I think that's going to be in the direct lending, middle market opportunities, and people focusing on secondary opportunities and really looking for the catalysts, for the market in terms of driving returns. And so that plus the, leverage levels, I think really at pre-recession levels we've seen, I think is going to drive a lot of activity, which we'll talk about here.
Jody, a little bit about your background?
Sure. So I've been covering restructuring and bankruptcy at Bloomberg News for the last few years. And prior to that, I was with the Wall Street Journal covering M&A and restructuring beat around 2008 when the auto industry blew up. So we've seen quite a bit in the auto industry. Now it's moving towards commodities-related stuff, retailers. And so I just want to start off by saying that for anyone who is involved in the restructuring space this year, our year has arrived. So congratulations for everyone. And so get ready to get busy. So what I see in January is pretty significant. My take on the outlook of this year is we are ripe for restructuring to pick up significantly in 2016. And here is why. If you look at the macro backdrop, GDP is not growing as strong. The Fed yesterday said that they're scaling back how fast the economic recovery has been. So we are probably less likely to see a March interest rate hike. Number two is if you look at the distribution of the high yield bond, very heavily weighted into CCC now. What does that mean historically is that's an indication of a lot more defaults. A lot of the companies are not doing well, bonds are trading down. So unless we see a quick turnaround in the economy, that's going to happen. Number three is the capital market liquidity. That has shrunk. For the first month of this year, we've seen $33 billion in high yield bond issuance. That's the lowest in the last 10 years. So yeah, we're going to see a lot more defaults this year.
Carl, a little bit about your background?
Sure. I'm a managing director at Madison Street Capital. We're a middle market investment bank based in Chicago. We're industry agnostic, but we do a lot of deals in energy, healthcare, industrial, and my group is financial services. And I think we're going to have a really busy year in 2016. Kind of like what Jody was saying, with the current capital markets, there's a lot of opportunities because at the end of the day, this is not like the credit crisis where people weren't prepared and there was a massive shortage of liquidity. There's a lot of liquidity out there, and I think people are going to be very opportunistic in certain markets, and we expect to be very busy both on the sell side and the buy side.
Thanks, Carl. And I'm Pat O'Keefe, and I head a firm that provides strategic and financial advisory to the middle market. I'm also a former TMA chapter president, so it's good to see my colleagues like Kathy Reese, Scott Victor, and Sheila Smith being honored and being part of this program. We specialize predominantly with auto, real estate, agriculture, and municipalities, and we've had a huge uptick. I would say the fourth quarter of 2015, we've probably seen more deals in those 3 months than we have in the last 3 years in the middle market. I'd like to kind of paint a background on the economic 2016 outlook and also where we've been to kind of frame some of the comments that the panel is going to make going forward. So if you look at the backdrop with the Dow Jones Industrial Average, just since the first of the year, we're down 9.6%. Gold and silver, which are great commodity hedges in down markets, is up 2 to 3%. But the S&P is coming off arguably its weakest return since 2008 with an increase of 1.4%, which was led by energy stocks being down 21%, and the U.S. corporate high yield bonds were even down 4.5%. Goldman Sachs believes that financials, utilities, and energy will continue to be down in 2016, and the big healthy prospects relate to healthcare, IT, and consumer discretionary. Ford Motor Company just announced today that they had record profits at $7.9 billion and issued a check for over $500 million to the UAW workers. The irony of that is their stock is down 20% year over year, in part because you're seeing ride sharing, the pressure on maybe Apple coming up with a smart car. And so the auto industry may be in the buggy whip stage going down with some of the pressures that they're going to have. And so I think Detroit keeps a watchful eye in the insolvency area for continued pressure in that area. Cash outperformed the market in 2008 to 2010, and we've had unprecedented returns since there. And I suspect to think that cash will be king in 2016 and 17. Some interesting trends. The market overall does fairly well after a rate hike. We've had our first one in 7 years, so that's of some interest. Oil is going to continue to stay lower. The Saudis will continue to protect their market share. And I have somewhat of a conspiracy theory on that. I think we're actually at war, and nobody's really declared it yet because we don't have troops on the ground and bombs flying through the air. But if you look at what's going on with the Russian economy, who's heavily dependent on oil, and things that are going on in the Middle East, I think the Saudis are willing participants with the United States to continue to put pressure on the Russian economy. And I think the Saudis have a dual purpose in that you've seen natural gas prices and a lot of the fracking operations continue to be depressed in the U.S., which has good long-term prospects, I think, for the Saudis and the barrel of oil. So as a consequence, I believe 2016 has all the makings of a very volatile year internationally, which will clearly ripple through the economy. But what's interesting, I went back, there was a good chart of 30 terrorist strikes that have happened over the last 20 years. And arguably, the market has performed very well 4 months after a catastrophic event that happens in the country, and which is a little counterintuitive. And I think, especially here in the U.S., because of the stability of our economy and that, we would not experience if there was some global unrest. The election is kind of fascinating in that when an incumbent runs for the presidential election, the market generally does very well. When you have a lot of newbies in the market, the economy generally tanks in the year of the election. So 2016 is already shaping up to continue the trend of negative returns in the S&P 500. Housing starts is of some interest, and some people feel construction will start to soften a little bit. We really haven't had the robust construction that one would expect. The U.S. peaked in 2006 in terms of housing starts, and even with the bump up in the last few years, we are still only about half of where we were at the peak. We do a lot of analysis in housing starts in our local market in southeast Michigan, and what was interesting is that in '06 we were probably at the peak, and then we had the auto issues, and the market just dropped precipitously. And I was trying to identify another city that had the same issue, and Houston came to mind, where they had 26,000 housing permits in 1980, and they basically fell off the map and didn't recover to that level for almost 20 years later. And so housing drives a lot of industries, as does the auto, and I just don't see housing improving here over the next year or two. So with that backdrop of our global and local economy, I guess I'd like to ask, I'll start with Carl, what opportunities do you see in 2016 for distressed investing?
I mean, oil and gas for sure, but I think it's not as transparent or I guess easy as people think it's going to be. I think there's a lot of companies out there that are more prepared, and again, it's not like the credit crisis where it was almost like everything happened really fast and people were rushing around and there's all this distress out there. I think it's going to be a much more planned process, and people, I think, are going to be very careful on the type of deals that they move on. Technology, and especially where we're sitting in the Midwest, there's a lot of technology companies I think are going to be, really impacted by other industries that, like say for example, payment technologies, companies that process payments for energy companies or healthcare. They're feeling the squeeze right now in terms of their fee structures and having their clients come back to them and asking if they can renegotiate their deals. So I think that's an area that people haven't really thought about that's going to get really impacted.
Mike, what do you think?
I mean, just to start off, as you mentioned, Carl, I mean, look, everyone's focused on energy, and it's hard to not talk about it. So, I mean, I think really, and there's other sectors, but energy is also, aside from just being prominent, it's where I think there's the largest amount of capital when you think about, sizes of equity offerings and public debt raises. And so I think that's, people, have already started to take large positions, in distressed names. Obviously, we saw the first wave of bankruptcies last year. It's going to continue this year. And, there's really going to be a tough decision for, I think, a lot of lenders who are in fulcrum positions and securities. Do they, ride it out, own the assets, or do they put more dollars in and, see what happens? And, I think the question is, when does oil come back? And obviously everyone's got their own view, but I think given the, demand supply kind of equilibrium in the U.S., but the kind of the pricing environment right now that's not economic, it's going to come back. It's just a question of, when is that? And that's going to factor into, lenders' decisions on what to do. And, whether it's a slow uptick or, one that kind of goes up and down quickly is going to decide, how people view the risk return going forward. And that's how people are going to decide.
Joe, do you get to write on these train wrecks as they happen? And I'm curious as to what things right now are on your radar screen in terms of potential industries and topics, and how that was different than maybe from things that you covered in 2015.
Sure. So definitely the biggest topic is in the energy space. And I want to establish that energy is all about timing. Last year, a lot of the hedge funds got in early in the year saying that they're calling the bottom, didn't pan out. Hedge funds was feeling a lot of pain. Some of them folded. Some of them had to cut their headcounts. This year, I think we're going to see the same thing going on. But where we are here at the where the commodity prices are is very different. Last year, we're at $90 a barrel. Now we're below. We actually hit below 30 barrel. On January 20th, we hit $26.5 a barrel, which is almost 13-year low. So how much lower can we get? That's the question everybody is asking. You can't get really much lower than that, right? You pretty much very quickly you're going to hit zero. So at some point it's going to bounce back because the demand is not going away. So I see this year the difference is people are going to time it very, very carefully when they get in, because a lot of people got a lesson last year, but they're going to get in. So from different aspects, from different perspective of what kind of investors you are, I think people are taking different kind of approach. If you are a bank lender, you are monitored closely by Dodd-Frank compared to last year. You'll probably be more cautious of how much you're going to lend. In October, the redetermination cut an average of 10% to 15% of energy companies' asset-based the facilities. This year, the most recent number came out saying that they are expecting 30%. Imagine the pain the companies are going to feel on top of that cut, and they're going to be very tight on capital. So bank lenders are looking at what kind of risk appetite they might be able to endure to lend. If you're a hedge fund, last year a lot of people are playing fulcrum. Where is the fulcrum? Last year a lot of the fulcrum people, the thinking valuation is at the unsecureds. For example, Samsung, GSO, so Blackstone's credit unit GSO got into the unsecureds. The result is the company went into bankruptcy and they got zero back. So Samsung's bond lost 100% in value in a matter of 12 months since its issuance. Zero. They started off at par and became zero in a matter of 12 months. That's a quick deterioration.
I think that's right, and I think a lot of the PE money also, stayed on the sidelines a little bit more than the hedge fund money, and they had, a lot of money raised and earmarked for energy opportunities, and they kind of sat on the sidelines to some degree and are, hoping to get, new money fixes, whether it was, debt raises, second liens, what have you, that we saw, at least in the first half of last year, and like if you look at the stats, in terms of funds raising new money, but like if you think about the growth equity funds, probably 60-70% of the growth equity funds, are raising new capital this year. I think almost virtually 100% of the distressed funds are, focused on raising money this year. So I think they're, maybe been a little bit more patient, and I think they also have, the distressed funds also have more strategic angles than I think they used to in the past, and I think we'll see them be, more competitive on a pricing standpoint in the future.
Yeah, totally agree.
Jody, what do you think, though? I mean, everybody's energy. What is the trickle down to that to potentially other industries that you think could have problems in 2016? And, is that different than what happened last year?
Sure. I think a lot of people are now thinking outside strict E&P drillers. So you think of energy. Energy is a broad industry. If you think of service providers, MLPs, transportation guys. So these guys kind of holding on last year. Their time, some of the smaller ones might get into trouble this year. So people are looking at shifting their focus from strict E&P companies to downstream. Other than that, coal is kind of peripheral in the energy space. Coal industry has been completely gone through the gamut of issues that you can think of. 6 of them filed for bankruptcy in the last 2 years. Now Arch filed, second largest coal miner in the United States, and Peabody is on everybody's mind. This is going to unfold this year and probably pretty quickly. Why? Because Arch Coal tried everything that Peabody supposedly can do and failed. They tried to negotiate a debt exchange deal, trying to bring their leverage down. Didn't work.
They thought they had it in place, and then it got thrown out.
Exactly. Because the senior lender, if you look at the senior lenders, they are freaking out because the valuation is deteriorating so fast. Not only the unsecured guys are wiped out, getting zero. Second liens are getting near zero. A lot of them are trading 15 cents on the dollar. So very soon they're going to be out of the fulcrum, and very soon the top of the capital capital structure will be the fulcrum. They're going to be the dip lender, the ABL guys are going to become the new equity owner of those restructured companies. That's not a pretty picture because the banks do not do business to operate a coal mine or an energy company. So,
Carl,
therefore,
what do you see that's different this year versus last year?
I think. Sorry.
I was going to say, one area where we're seeing a huge opportunity is actually cross-border and deals in Canada. So Canada, right now the currency is getting killed. It's like almost at I think their 16-year low, because Canada is viewed as this resource-heavy country. I'm actually born in Toronto, even though I live in Chicago. 90% of Canada has nothing to do with resources. So we're seeing these companies that have, beautiful companies, really profitable, that they're thrown into this bucket as, this, distressed country or, resource country that's, so dependent on oil and gold prices. We've got 5 engagements right now where they're Canadian companies that they're looking to be sold. Beautiful balance sheets, highly profitable, and guess what? U.S. private equity firms, they love it because it's not related to energy, and in Canada the legal system and accounting system is very similar to the U.S. So there's no brain damage in terms of learning what this company does and how to get a deal done. So I think that's a positive out of all this oil distress.
It's kind of interesting, from our perspective, and industries go into cycles. And right now, at least in our world, we're seeing a lot of scrap yards. Scrap yards have been in existence for, 6, 7 generations because of, again, commodity prices for non-ferrous metals that have just fallen off the face of the earth. And Jody, to your point, when you have, and I'll speak to the middle market, lenders who really can't afford to take losses or want to take them quickly, and I would put the too big to fail bank, where they just don't have tolerance for a small credit where they can easily sweep it under the rug and just get rid of it. They are not going to take the commodity risk of their client that is heavily determined their inventory values on commodity pricing. They just won't do it. And we see a lot of hemorrhaging starting to happen. We have 3 now scrap yards that we're dealing with that have been healthy companies for decades, now trying to figure out what to do and how to match their production with demand and how much they're willing to take risk from the inventory standpoint. And it's a scary proposition. The other dynamic, and I'll speak a little bit to auto being in Detroit, which is fascinating for me. I mean, here we have, north of 17.5 million units being built in North America, a rather robust industry. However, again, companies that have hedged their bets globally, where they've been told by Ford, General Motors, Honda to expand their operations globally, are finding capital constraints as everything shrinks back in order to maintain their core business operations. And I have seen most recently a lot of middle market auto companies that are facing either the dynamic of the shortage of working capital, or 2, their major customers are starting to pull parts back into the plant. And these things all roll into cycles. So when you lose a 30% product offering with Honda because they decide to pull in the part you're making in-house, that's a big loss. And it's not easy to quickly rescale your operation when you've got investments in plant and equipment and tooling. The workforce is easy. I mean, you can get rid of those people relatively quick, but in auto, it's only 10 to 15% of your product cost, so that really doesn't solve the problem. And we're seeing a lot more of that when you wouldn't expect it in a rather robust market. Do you find that there are certain industries that are maybe a little tougher to, restructure, or acquire in a 363 where people kind of stay away from it? I'll throw that out to you, Mike.
Yeah, certainly. Healthcare is certainly one that comes to mind. I mean, it's just a formula, a lot of it's formula based, and I think there's just uncertainty, reimbursement rates, and where they would end up. And I think certain folks have an appetite for that and understand reimbursement risk and what that can bring, and others don't. And so I think, certainly healthcare is one. I think certainly other areas that just have high fixed costs, for example, energy, both on the production side, and on the equipment side. It's going to be a challenge.
Carl?
I think certain technology companies, especially earlier stage ones where they don't have 10 years or 15 years track record of their technology being a proven technology or accepted technology. But that being said, I think distressed buyers are a little bit more educated. So, for example, there's a group that I deal with where they essentially hired 10 analysts to focus on patents. And when they look at a deal now, they'll totally scour the IP and assess a value. Whereas like 5 or 6 years ago, they would just look. They would ask like 10 questions about a deal, and they would make a judgment based on that and say, yeah, this is for us or this is not for us. So I think people are a little bit more savvy in how they look at opportunities, and especially like with technology, there could be a tremendous amount of value in the IP, but you would have to know what to do with it, and and what would be the end user, or who you would sell it to eventually.
I think it goes to having, if you have heavy on equipment or things like that, I mean, having a dual purpose, for example, of a piece of equipment is hugely valuable right now, especially, in energy world where, even though you may have a contract from a, top tier credit rated, offtake, that customer who's one of your biggest customers may just say, hey, even though we have this contract, we'd like you to reduce the price, and what do you think about that? And you're going to have to kind of, make amends. And so I think from a lender standpoint, if you've got dual purpose collateral, that is opening up, I think, more ability to get the lenders to the table where they're weary right now of what's going to happen, even if you do have contracts in place.
So in distressed transactions that you've seen in the last 12 months, and to the extent that there's been a bankruptcy that's resulted in a 363 sale or some type of reorganization among the creditor group, do you find that the companies that are most successful have intellectual property that's of interest to stay in the game, or is it some unique aspect of their operation that buyers find potentially attractive? And Carl, I'm going to start with you with that question.
Sure. I mean, I've seen both. I mean, I've seen ones where it's purely IP transaction, and they go through the 16 different patents, and they the one that's got the most value. Well, in this one case, 15 were worthless. Like, and the one that was of interest was what was driving the auction. In other cases, I've seen opportunities where it's more of a setup, like infrastructure play. So the buyer, the eventual buyer, had a huge operation in India, like where they're offshoring this particular service. And when they bought this company in bankruptcy, they were able to leverage what they already have in India. So for them, they actually overpaid, because they knew they could actually, I think it was like triple the amount of sales based on the infrastructure they had built in India.
Mike, I'm going to come back to you with the same question, but I want to give a little more of a backdrop to that. So if you look at, for instance, like the Hostess bankruptcy, what was of interest in that? It wasn't the property, plant, and the equipment, or the inventory, or even the customer base. It was the brands, it was the formulas, it was things that weren't necessarily on the radar screen or what traditional lenders would lend against. And the greatest story that I have heard is the Penthouse bankruptcy, where the domain name penthouse.com was bought for $50 million, and none of the secured lenders had it tied up, which created a windfall to the unsecureds. And so, when you have companies that don't spend the time documenting their intellectual property, thinking about it, how to protect it, and whether or not it's a real asset, whether or not the lenders will actually lend against it, is of really no consequence when you get involved in a distressed transaction as to the value of the enterprise and the potential ability to negotiate and work out a settlement with your creditor group. And Mike, I'm just wondering, what experience you've had or seen with that.
Yeah, I mean, I've never heard of Penthouse, but I kind of understand, what you're going with on the brand. Basically, last year I think we were, there were two deals I worked on where we got money, full value to creditors through a bankruptcy, or in one case, money to equity. And in one of those instances, it was purely brand driven, where, basically it was purely brand driven in terms of where they could drive the business going forward. You had to put some capital into it as a healthcare company, well-known name. And then, another one wasn't a brand. It kind of went to where I think Carl was going. Just had a IP, technology platform where, it wasn't making any money on its own, but they had, a processing business that had billions and billions of dollars running through it, not making money, but they were able to leverage the technology and basically offload it to someone else who, could, essentially reduce their costs in half. And, that was how profitability was, value was given to equity.
So Carl, when you're involved in a transaction like that, where you're trying to see if there's something you're going to be interested in, and you start to assess the real value in the company. From a due diligence standpoint, where do you start? How do you look at companies? How do you develop maybe some unforeseen, target strengths that the average buyer might not be paying attention to?
Well, I think the first step is knowing your own capabilities and what exactly where this would fit in your platform. Because I think sometimes people rush that part and don't really figure out how this particular acquisition or asset will fit in their platform, and then they end up having a square peg trying to fit it into a hole. So number one would be that part is just making sure you have strong people in that particular division or whatever that can put together an analysis of how this would work. And then the second part, I think you really do have to rely on sometimes outside help, especially when it comes to IP, for example, because the deals that we've done there, it's not easy. Like you really have to understand how, like Mike was saying, this IP works, and is it a brand, for example? Okay, well, how do you assess the value of that brand? A good perfect example is like Macy's when they bought Marshall Fields. There's a huge value to the Marshall Fields name, even though it's right now never not being used. It's dormant. But one day, you never know. Macy's might want to do a new Marshall Fields, line of retail stores or a brand, whatever. But how to assess that? You need people that actually do that every day to come up with the value.
Now, we had an interesting strategy, I think, within our firm about a year ago, and that is bringing on a brand consultant to help companies start to develop their intellectual property, because most business owners really don't think about it. We have a case right now with an automotive staffing company that has developed some desktop tools, and they view it as a tool to sell a commodity-driven staffing hours. And we said, why? If you're viewed to be a technology company, the valuation for technology companies far exceeds staffing companies. And so why not figure out how to maybe shift gears as to how the public and your customers perceive the tools that you provide to them. And we had a very interesting conversation on the pricing of the tool. And they're selling this all over the world to their OEMs, and they didn't know how the customer was using it. They didn't know how to price it. They said, well, it took us a couple $100,000 to develop it, and we could sell 2 of them right out of the chute, so we were going to charge our customer $100,000 for it, and they paid for it. And I said, the ability to mine how the customer's using it, the cost savings internally, and what the value add is important data and information to capture, to position both the pricing of that and the marketing of it, to really reposition the company to maybe do something a little different. It's the same business, but how it's packaged and how it's viewed by a potential buyer. And it's a distressed transaction now with great opportunity to take the next step if they can figure out the branding strategy. And I think companies don't spend enough time thinking about it, and there's a lot of intellectual property that gets brushed to the wayside in bankruptcies that people don't normally see. So Mike, when you're involved in a distressed transaction, or you're helping a client on a buy-side due diligence, what things do you look for, or your clients looking for in that space?
Yeah, look, I think a lot of times in distress, you've got companies with negative EBITDA. There's a transformation underway, but it's hard to, sometimes it's hard to articulate the story off the bat, at least for people. Certainly, investors who are generalists or not necessarily have a platform opportunity. And I think really, what we look to do, and we try not to work on deals, at least as Raymond James, as generalists, we work with our industry guys who can provide, the insight along with the restructuring skills. But, we, even though sometimes it's far-fetched, we like to show folks what the real upside is, even if it's like far-fetched. I think people, when they're going to their committees on, basically putting in new dollars into an investment, they want to know what the upside is. They don't want to know what the, kind of moderate low growth case is and, get a small return. Even though it's low probability, they want to be able to say, look, if we do invest in this new brand or invest in this new tool, we're going to double our sales. And even though we're not saying it's going to happen, we're not saying we have the direct path to get there, we want to at least lead people down. Hey, it's a tough macro environment. The company, in often cases could be negative EBITDA, but here's a couple different paths as to how you can turn it around. And not everyone's takers, but if people are specialized in that industry or have an angle, there are people and the right buyers for it.
So it's interesting to me to see how the Turnaround Management Association has expanded into a global organization. The M&A Advisor now has more conferences and things globally than they've ever had over the last 4 or 5 years. And cross-border M&A has been very hot. And I'm wondering, with China slowing down and showing some signs of weakness, what the opportunities are. And Carl, I'll defer to you. Based on some of the transactional volume you see, what do you think some of those opportunities would be with China slowing down?
That's a good question. I've worked on a few cross-border deals in China, or I wouldn't say worked on it, to be honest. They're hard, and it's hard to get people interested. I think maybe on a very large scale, like if you're talking multi-billion-dollar sales companies, there's going to be activity there, but on a smaller scale, at least from the US-based investors that I deal with, they don't want to touch emerging markets or even developed markets that are international. I think it's too much risk. There's too much opportunities in North America, so it's all. I guess the argument would be why focus on, say, South America, like or Brazil, for example, when you can get a perfectly good opportunity in California. So I think, although there will be opportunities in places like China, my suspicion would be there'd have to be very big transactions where it's like groundbreaking, like a huge car manufacturer, for example, getting bought by GM or something.
Well, it's funny to hear you say that because, we take a lot of things for granted in the United States, but we have a fairly stable political, judicial, and legislative environment here that allows us to conduct business. And I don't know how many of you saw, but I think a couple of months ago, the first patent infringement case was favorably awarded, to a Western company for, being able to protect some intellectual property they had. And, the ability to get capital out of China is not easy. And, a lot of the opportunities that have been seeded by U.S. companies have really been the dilution of working capital and working capital assets to expand globally. And when things get bad, it is so hard to immediately pull that in because you've got the unfavorable tax, you've got the unfavorable government situations where you have limitations as to the amount and the timing of being able to pull capital. And I wonder, with China, Brazil, Brazil may have regime change and a total currency collapse this year. How do you take advantage of those opportunities with all those impairments? And to your point, there seems to be more attraction to dealing in a stable environment to find those opportunities than it is to roll the dice or spin the roulette wheel in an emerging market. And I wonder, Mike, if you have any thoughts on that or any?
Yeah, no, I think it's, to be honest, slightly different. I think it's lost opportunities when folks are, we're looking for that as an avenue for, a new sales channel or a new supply channel and, bringing in goods at cheaper cost. I think they're now second guessing whether those savings or those new revenue opportunities are going to be there. And, if they were making investments based on that, they may second guess that.
Joe, do you have any perspective on some of those companies that are doing global M&A as to any issues that they're going to be facing with the turmoil? Any things that you might be covering here in the next year that are on the radar screen?
Not so much on the global M&A front, but I do see people are focusing on watching the China GDP slow down, how the construction slowdown is going to impact certain areas in the U.S. One of the industry that will be hit the most will go back to coal, met coal that's used to make steel. Demand for that has dropped significantly because of the China slowdown. So I think people would see. So the coal companies that actually levered up and borrowed money back in 2011 made huge bets on met coal price going up. Haven't seen that pan out. So I think that's one of the biggest industries that's going to be hit by the China slowdown. And in terms of the investment cash flow, as we all know, there is a huge outflow from the capital in China, which is a reversal from what we've seen over the years. Instead of U.S. money going in, now it's all the China money coming out, leaving that country. So does that mean that we're going to have more liquidity here? I'm not sure. You do see a lot of Chinese buyers buying up U.S. assets in different sectors. You see in the media industry.
I've been told by several Chinese investors that one of the great attractions is the stable U.S. economy. We have rules here that don't exist in other countries, to protect business opportunities, and I don't see that dynamic changing anytime soon. And maybe with a global pullback, it'll make the U.S. that much more attractive. Carl, I'm going to put this out to either Carl or Mike. Compared to now, and comparing it to 2008, do you think hedge funds are able to move quicker now? Were there any lessons learned? Are there, what do you guys see?
I think they will have to be decisive, because the folks that last go around were indecisive and, for example, took, 7, 8 months, 9 months in bankruptcy to figure out if they want to own the assets or, take their losses now, I think did poorly. And I think this time around they've learned their lesson and they're being decisive on taking action, whether it's, pre-filing and, in often cases seeing folks, exercising on their pledge of stock and reconstituting the board and driving to get things done early on out of court if they can, and if not, executing it through a sale process in court. And I think folks are being mindful of that this go around, and they're set up internally to deal with things quicker than not.
Carl, you got
Yeah,
anything?
I agree, and and I think back in 2008, I worked with about probably 10 different ABL funds, and they just got slaughtered. Like their NAVs went like overnight, or within like say an 18-month period, to basically zero, because number one, very loose underwriting, 2 high risk industries that they were investing in, like no offense to Florida, but like risky Florida real estate projects, life settlements, film rights, you name it, like all sorts of crazy asset classes. But this time around, I think funds are much better. They're more responsible. I think more due diligence that on the different investments that they're in or loans that they've issued and or lent to. And although there's still some risky, risk takers, I think it's not like 2008. Now that being said, 2015 was a bad year for hedge funds in terms of performance. So watch 2016 to be a lot more activity, I think, both on the transaction side, because they got to prove to their investors that they can beat the S&P. In 2015, most funds were below it.
They were, and I think it speaks to the dynamic. I think it's just tougher to make money, being a hedge fund these days and, playing the odds. There's so many dynamics that go on with companies that are in distress, and to be able to hedge your bets. I think it's going to, and combined with the fact that there's a greater demand of money out there, or a greater supply of money out there chasing deals, that the ability to, sharpen
Well, you need
your
volatility
pencil.
too. So I think good news is 2016 is off to a good start in terms of volatility. And I think honestly, there's going to be some big home runs with some of the hedge funds out there that we deal with, just because they've been saving. It's almost like they've been saving their money, their allowances for the last few months, and now they're going to put that money to work when they can, and in really opportunistic situations where they can get a big yield.
Do you think they've tempered their yield requirements in light of what's happened over the last year or so?
No, I don't think so. I think now they're finally be able to exercise or execute their strategy on a playing field that they're used to. Last year was tough. I mean, you're competing with banks and regional banks, for example, where like for us, we get calls from everyone, in terms of the deals that we have, on the private debt placement, and like regional banks that usually are very risk adverse, we're basically looking at the cash flow deals that they would never touch, before. But now, so hedge funds and BDCs were competing against those type of lenders. So it made it harder for them. But I think this in 2016, regional banks are not going to be as aggressive.
I think if you were looking for, if your question was more focused on the private equity side, and how they're looking at returns, I think some of the PE folks are okay with, a lower targeted threshold, if you will, and looking to, potentially get in on the debt and, say, look, if I only get, 15-20% return, and that's kind of my base case, that's okay for now, but I'm okay owning the asset and riding the upside. I think we're going to see a lot more of that this year. And
15% is pretty good.
Well, it is, and it's great.
Yeah.
Most funds last year didn't achieve 10 to 12%, but we do a lot of analysis on pension fund performance and actuarial underwriting. And when you look at historically, most pension funds have expected 8 to 10% yields on their overall fund balance, and most of them are barely scraping 5-6, and some have had losses over the last year. And you see everybody kind of shifting their expectations down where, maybe PE funds wanted 20 to 25%. They can't get it anymore. And so, maybe they've got to shift to 10 to 15, and that still looks pretty good versus, what you would normally be investing, assets as a fiduciary for and being happy with 6 to 8. So I think, the expectation level, while there's still more money out there, I think it's just harder to make money. And, Carl, to your point with the banks, I mean, the deals have been slightly more risky because there hasn't been the loan demand, as business owners and consumers have all deleveraged. And so as a consequence, I think the stat out now that less than 10% of household income goes towards debt payment, which is historically at a 40-year low. So households have deleveraged, businesses have deleveraged, and so where you're out there making cash flow loans, it's almost a sign of desperation to try to get money out and get a yield on it, but it still doesn't create the value that these funds are going to be looking for when you've got cash flow, lending out there. You're just taking off the top, part of the lending formula that really provides no value. There's no hard assets. There's no nothing to grab onto.
I just want to add that I think 2016 is probably going to be a better year no matter what for hedge funds and private equity firms compared to 2015, because so many guys were got a lot of losses. But I would say that they will be more thoughtful and cautious in terms of where they land and where they're going to land in the capital structure. I see a lot of rescue financing on the top of the capital structure, DIP loans, pieces like that. I don't think there is any appetite to getting junior pieces anymore, like what people have done last year.
Jody, I think I'm going to take that bet because I don't see the yields this year. I really don't. I think there's going to be a lot of volatility in the market, if for no other reason than global unrest and just the uncertainty with a lot of things, and the implementation of additional Dodd-Frank constraints and that. I think there's got to be a whole shakeout this year. But on that note, and I'm going to start with Mike and I'll work across. What items this year are going to impact transaction flow or the economy? What, if you had to pick a couple of events that could move the needle either way, what do you think drives the economy this year and the ability for distressed investing?
I think when I look at it, leverage levels are what they were to the lead up to pre-recession, and the differentiating factor now, aside from just not being in the financial crisis, I think when you look at the metrics, the coverage ratios, in terms of companies having the cash to service the debt, are much higher, turn higher, 20-30% higher. And so I think when you think about why is that, it's really, twofold. Potentially, it's, interest rates are at all-time low. If those tick up, I think they'll start to feel the pain, and you'll start to get to a point where those coverage ratios aren't, sustainable, or folks just have deferred capex, and they're waiting, on projects, and that hasn't shaken out yet, and we'll see what happens.
So do you want to make a prediction on prime?
50 basis points.
Up, I'm assuming. Jody, what do you think? What moves the needle this year, one way or another, in terms of some stimulus or something impactful?
As soon as you ask that question, I have 3 answers in my mind, and I picked Dodd-Frank. The reason being, is going to impact directly on the lending basis, and who the lenders are this year is going to change because of that, and that directly impact the borrowers, the ability to borrow and their ability to negotiate with their lenders, and how they're going to negotiate with their lenders, because it's very different to negotiate with Wells Fargo, Bank of America versus Oaktree, and guys like that. So I think in a lot of cases, if lending continues to stay tight, a lot of the borrowers will continue to have trouble.
All right, before I move to Carl, I want to just follow up on that because we had a conversation offline before this session on shadow banking. Do you see that becoming a bigger piece of the secured lending versus the normal institutional?
Yes, I think Dodd-Frank, another impact on that is banks are so reluctant of taking risks nowadays, being monitored. Essentially, you have your regulator standing over your shoulder and looking at what you're lending. The most cautious approach to deal with that is do not lend or lend carefully. So guess who is going to fill the gap? Hedge funds and the private equity firms. We've seen a lot. Oaktree have done a number of big deals in the rescue financing and the DIP loans in the past year, and they have not stopped doing that in 2016, and I would not see that stopping anytime soon. Yes, I think shadow banking has become one of the major forces in driving distress, and it will be a very interesting point of view from a reporter's point of view, is because the dynamics changes, and the guys are very savvy in distressed investing, now talking to the borrowers what's going to happen, and we'll see.
All right, so before we leave that, one last question. So shadow banking today makes up about 25% of secured lending. Do you see the government jumping in and regulating that in some capacity?
I think that's been talked about for a while, whether the unregulated piece of Wall Street should be regulated, and I think a lot of people's answer would be yes, it should. Would that happen anytime soon? My personal take is I think the Fed has bigger problems at hand. They have to deal with the big banks and prevent us from falling into another financial crisis. And I think that's the priority. It's going to be priority of this year and then maybe next year. So shadow banking will be the next thing on their agenda. I don't know. I don't see they're going to get to that anytime soon.
Yeah, and I think I would agree with you too, because there's really no impetus to do that. Unlike the institutional banks that are taking depositors' money, which they have insurance against, they have a vested interest in making sure that there is some regulation and oversight. Not so much with shadow banking, who doesn't take deposits, so they may keep that on the shelf. Carl?
I think I agree with Jody and Mike. I think it's unusual. I think there's a lot of unusual factors right now going on. In the global macro view, like you have interest rates that are still very low, unemployment's still low, strong U.S. dollar, slow GDP. Like at the end of the day, there's a lot of people are going to make a lot of money, and a lot of people are going to lose a lot of money. I think in 2016, there's going to be increased volatility for sure in the capital markets, but this time there's going to be people that actually have dry powder that they can actually put to work and make money off of that volatility. Like I said, cross-border M&A, especially Canada, maybe like places in Europe where American companies can capitalize, especially like multinationals where they have strong trade relations and nearest currency reserves that they can put to work. I think there's going to be a lot of activity there. But overall, it's just going to be a shaky ride for 2016.
Yeah, I think the one thing that concerns me in wrapping up is political and social unrest. To me, that could be a real deal mover in one direction or another. And if you've seen, since the first of the year, there's been a number of big layoffs. And I often wonder, in some areas, how you can have solid democracies without a strong middle class. And the middle class, over this expansion, has been hammered. the people at the top have done really well, but the people in the middle not so much. And I wonder, with everything that's going on in the world, whether this bubbles up this year. Interest rates fascinate me. They haven't really moved at all for the last 7 years, but we've had times of severe volatility, 71, 72, 73, 80, where prime has moved anywhere between 20 to 40 times during the year. And the Fed is on record, saying that they like to adjust prime 4 times this year. It'll be curious to see which way that goes, and I think it'll put additional pressure on people that are marginal performers in this economy right now. So with that, I want to thank the panel and thank you, and we are finished.